modern stock market and you see a hyper-efficient digital network. Trades are executed by complex algorithms in mere milliseconds, operating on a scale that seems completely divorced from human emotion. The roots of this global system sit in a very unlikely place, 17th century European taverns, where brawling merchants drank, shouted, and bartered to invent the world's first shares. How exactly did a system of barroom wagers and handshake deals grow to dictate our $100 trillion global economy? And why, despite centuries of massive technological upgrades, do market crashes continue to occur with such regularity and devastating force? To understand why your retirement portfolio fluctuates today, you have to look past the computer code and study the deeply flawed, highly emotional history of the market itself. Welcome to New Knowledge 101. The word we use for markets across Europe, the bourse, started in the Belgian city of Bruges. The van der Beurs family ran a local inn, and their courtyard became the primary spot for traveling merchants to meet and trade debt. By the early 1600s, the action shifted to Amsterdam. The Dutch established the first true stock market to fund their global trading companies, and almost immediately, traders figured out how to rig the game, executing the world's first recorded short squeeze in 1609. Across the Channel in London, stockbrokers tried to conduct their business inside the stately Royal Exchange. They were quickly expelled for being entirely too loud. Exiled to the streets, these brokers simply relocated to nearby alleys. By 1698, they organized a highly profitable trading hub operating straight out of Jonathan's Coffee House. Americans prefer a slightly more romantic myth for their financial origins. The legend claims 24 polite brokers signed the Buttonwood Agreement in 1792, formally creating the New York Stock Exchange in the quiet shade of a Wall Street tree. Eventually, these outdoor gatherings and coffeehouse tables consolidated into massive, formalized trading floors. They established strict social hierarchies, like the elite top-hat-wearing brokers of London, putting a highly institutional veneer over what was essentially an organized betting ring. But putting a roof over the market and dressing traders in suits didn't tame the chaos. It simply provided a larger arena that allowed human greed to scale up. The first catastrophic consequence of this massive new scale arrived in October 1929. Throughout the 1920s, average Americans bought stocks on margin. By putting down a small cash deposit, investors could borrow huge sums to buy shares, massively inflating their purchasing power. But the moment the underlying asset dipped in value, that heavy leverage unwound, collapsing the entire stack. On Black Thursday, that collapse became a reality. Billions of dollars evaporated in hours, wiping out fortunes and sending massive, panicked crowds into the streets, triggering the Great Depression. Decades later, the location changed, but the behavior repeated. In 1980s Japan, a cocktail of aggressive central bank policies and sheer overconfidence pumped real estate and stock values to impossible heights. When that bubble burst in 1991, the resulting economic stagnation devastated the country, leading to a grueling period known as the Lost Decade. By the late 1990s, the mania shifted to the internet. Web startups adopted a get big fast mentality, burning through venture capital on lavish marketing campaigns instead of building profitable businesses. The defining symbol of this irrational exuberance was the Pets.com sock puppet, a multi-million-dollar mascot for a company that went bankrupt in just 9 months. When reality finally set in, the dot-com crash wiped out $5 trillion in market capitalization. Whether investors are speculating on 1920s steel production, 1980s Tokyo real estate, or 1990s web domains, the underlying architecture of a crash is identical. A rapid expansion of credit feeds a frenzy of overconfidence, followed by a violent panic. By the late 20th century, the financial industry decided it was finally time to cure this historical volatility. Their solution was to remove the physical human element entirely. The turning point came in 1986 with London's Big Bang. The chaotic, screaming open outcry pits were replaced, and trading floors transitioned to rigid, computerized kiosks. The electronic revolution promised a future where human emotion and hand signals gave way to algorithms operating 24 hours a day. But stripping humans from the physical trading floor did not cure the boom and bust cycle. High-frequency networks now execute the same human manias that gripped coffeehouses 300 years ago, only now they do it in milliseconds. The technology has evolved from tavern handshakes to server racks, but the central flaw is still human nature. If you want to master the $100 trillion market today, you can't just study machines. You have to study yourself. Thanks for watching New Knowledge 101.